looks like a dozen lenders here, that's great, Now, there may be some lenders in this room who have the ability and the willingness to hold on to the guaranteed portion of USDA loans on their balance sheet. And for them, I have two pieces of advice. Lehman Brothers, before it went bankrupt, 3 days before it went bankrupt, was regarded as one of the most well-capitalized institutions in the country. And the second thing is that guarantees provided by government agencies are conditional. They're conditional upon meeting all the requirements under the lender's agreement, which means that the only way for a lender to perfect the guarantee is to sell the loan in the secondary market. Now, most institutions, the smaller community banks, obviously look to the secondary market as a source to provide liquidity and help monetize all their efforts, in addition to, of course, perfecting the guarantee. But that's in stable markets. And of late, when I say of late, I'm going to share just my experience of what I have seen in the markets over the last 60 days. And do we have anybody in the secondary market here in this room? Okay, we got Keelan there, okay. All right, maybe you can correct me, if you hear something that is different, okay? Of late, over the last 60 days, you might have observed as lenders, the market has been slightly different. And what is different is that the broker-dealer inventories have gone up. They've gone up to $1.9 billion, which is a very, very high number for the broker-dealer community. And so the broker-dealers do not have any appetite for warehousing loans and then finding a buyer at a later date. So they want to be able to find, the ultimate investor that will invest in these loans. But the problem that the broker-dealers have is that the investor sentiment has changed. The yield curve has changed the alternatives that are available to investors, and that has changed the sentiment. And that's there. Now, anytime you have broker-dealer inventories going up beyond $1 billion, there is some impact on prices, and we are seeing that. But in addition to that, there are a lot of other things that are happening in the market. The market that I have seen, and again, Keelan can correct me, if she sees anything different, it's a tale of two cities. There are some lenders and some sectors of the economy that are attracting, reasonably strong bids. And there are other, situations where we are seeing in the marketplace where lenders are not getting enough bids, or they're getting bids on pieces of loans, So specifically, on these larger size transactions where you have a $15 or $20 million loan and you've got a guaranteed portion that's north of $10 million, I have seen a lot of lenders, complain about not getting enough bids or getting bids on only pieces of it. And they have ranged from the low-hanging fruit, usually, things like hotels or gas stations or manufacturing wholesalers or even solar loans. But a lot of our experience, now liquidity evaporating is nothing new in the secondary market. We saw that in the 2008 environment when we had the global financial crisis. Now, our immediate experience that you see in the secondary market is also a function of the lag time that's involved in originating these USDA loans. It takes 6 months to a year from the time you start originating the loan till the time you come to the market. And if you think about it, a year ago, we had low interest rates, markets were stable, there was no inflation problem, yield curve was not inverted, all lenders were making a lot of money in terms of premium. And in that environment, a lot of decisions were made by lenders that did not anticipate the rate at which the yield curve might change or the rate at which the Fed might aggressively increase interest rates. And so they went ahead and they said, okay, I'm going to fix the rate on this food supply loan for 3 years, not realizing that you can't sell that loan till you disperse it, and it takes time to sell, and by the time you disperse, the 3-year, if rates have moved significantly and you're not making as much money as you thought you might. So a lot of, agony there on the part of lenders. Likewise, there may have been construction loans where lenders got involved in construction loans expecting a stable market, and then, things changed, and when the construction got completed, again, they have the same situation. I've seen situations in solar loans where, in order to attract, and the solar loans have been performing extremely well. So the lenders that were involved in these REIT projects, they went ahead and fixed the rate, months ago. And suddenly you come to the marketplace and realize that the short-term rates have moved up so significantly that you have to take that deal away from the market or withdraw it from the market. And so the lenders who have been used to seeing a very stable market, low interest rates, negligible, inflation, high premiums, they've felt that the rug has been pulled from under their feet a little bit. And the challenge of the market environment really is twofold. One is borrowers have gotten used to low interest rate, and the lenders have got used to very high premiums. And the two can't coexist in this current yield curve environment. That is the challenge, that you have. Now, I'm here to just talk to you briefly about, what happened with respect to interest rates and when we can expect some level of normalcy. And I'll start off, first of all, saying that I'm glad the elections are over, thinking about the elections, my respect for Ronald Reagan really went up significantly. You might remember that he coined the phrase, "Are you better off today than you were 4 years ago?" He was known as the great communicator, right? That's because he took a complex economic concept of misery index and he communicated it saying, "Are you better off 4 years ago?" Now, the White House Council of Economic Advisors came up with this misery index concept, and there's a reason why I'm mentioning that. And this is during the administration of Lyndon Johnson. And they came to the conclusion that the two main factors for how people feel about the economy are really unemployment and inflation. And they did more studies on it, and they came to the conclusion that for every 1% change or increase in unemployment, there's a 2% impact on inflation. So the economists, like they normally do, they came up with saying, what is the misery index? And so you take the unemployment rate, multiply it by 2, add inflation, and you get the misery index, right? And here is, when Reagan stood for election against Mike's former boss, Jimmy Carter, unemployment was 9.8% and inflation was 12.65%. So if you follow that logic and you multiply the 9.8 by 2 and add 12, your misery index is around 32. Obviously, Reagan won by a landslide. People did not feel very happy about what was happening in the environment. Fast forward to Obama. He got a shellacking, right? Now, during the Obama era, the inflation was very low. It was 1.2%, but unemployment was 9.4%. So if you use that formula again, you come to about 20%, as the misery index is still high, and that's why the Democrats lost 63 seats in the House, as somebody pointed out this morning. Fast forward to what happened in this election. Now, here we have 3.7% in unemployment and 7.7%, in inflation. Misery index is about 15. Not as bad as what is happening during the Obama years or the Reagan years, but still bad enough. And the Republican Party should have obviously had better results, but I guess the Trump factor came in. Now, why am I talking about the misery index? Because when you think about it, what is it that the Federal Reserve has as a mandate? Federal Reserve has got two mandates. They want to make sure that inflation is targeted and is kept below 2%, and we'll define it a little further. And they want to maximize employment. Sounds very much like the misery index, right? Now you tell me whether the Fed is apolitical. Okay. Now, so the Fed is really the elephant in the room. And so what did the Fed do? Fed obviously went about increasing interest rates very, very aggressively this year. When we started the year, prime was 3.25. Now it's 7%, going maybe 7.5. This month. They took the Fed funds rate from 0.25%, and it's at 4% today, all in a matter of 6 or 7 months. So is what Fed doing today the normal way the Fed reacts? What is the history on that? If you think about it, we had another situation in our history, when I say it's history 100 years ago, where they didn't have COVID, but they had the Spanish flu. It's right after World War II. There again, inflation was 24%. And at that time, what did the Fed do? They increased the Fed rate, the Fed funds rate, from 4.6% to 7%, but they did it over 2 years. What did the Fed do this year? We don't have an inflation of 24%, we have an inflation of 7%. Actually, it's less when we get into the definition. And they went about hitting it with a sledgehammer and aggressively increased Fed funds rate from 0.25% to 4%. Right? So what did it do? It's not just the absolute increase in the Fed funds rate that is the issue, but the pace at which they went about increasing the rate that has caused the problem, And when you think about it, and I'm looking at the sheets here as to when inflation started, inflation actually started picking up in April of 2021. And the Fed did not react or start increasing interest rates till April of 2022. So the Fed has been criticized for being very slow, for fighting yesterday's battle. They were very optimistic last year, and they're very pessimistic this year. Even though, if you look at the inflation data over the last 3 months, it appears to be going down. Now, what data are we looking at, Now, inflation, again, has got different ways of measurement, right? You've got CPI, PCE, all kinds of terms that are being thrown with food and energy, without food and energy. The only difference between the CPI and the PCE is really where the data is coming from. In case of CPI, it's coming from consumers. In case of PCE, it's coming from businesses. And PCE is more broader and timelier measurement of consumer behavior, and that's why the Fed prefers that. So when we say inflation is at 7%, we're really talking about the CPI number. The PCE number is much lower. And the core PCE, where you take away the food and energy, is only 5.1% today. Now, inflation happens when goods and services are exchanged for money, right? So, what are the goods and services we're talking about? We've got everyday goods that we go and buy, like food, groceries, gasoline, everything else, where you see the price increases on a daily basis. And you also have, on the other end, durable goods, like cars or appliances or furniture, where you don't see that inflationary impact on a day-to-day basis. You have that. So what the Fed is doing is really using the core PCE and is taking out the volatility associated with daily increases of food and energy. That's what the Fed is doing. So what the Fed did was they started aggressively hiking, and today, what you can get on a one-year treasury, when I last looked at it, was 4.7%. It's a higher yield than what you can get on a 2-year or 3-year or 5, 10, 20 years. It's never been this way. And in April of 2022, when they started, increasing the rates, the yield curve slowly started inverting. And if you look at the 10-2 spread, the 10-2 spread is really commonsensical way of looking at it is to say, if I'm taking a risk for 10 years, I deserve to get paid a little more by way of compensation than if I take a risk for 2 years. And on a long-term basis, that spread has been 91 basis points. That means anybody who took a 10-year risk was supposed to get, I'm talking about treasuries here, 91 basis points more for a 10-year risk compared to a 2-year risk. Today, the 10-year yield compared to the 2-year yield is negative 0.8. Okay, so you have that situation where the yield curve has become negative, and the yield curve usually turns negative somewhere between 6 and 24 months before a recession, historically. Okay. Now, of course, the negative sentiment coming out of China adds into this recession outlook, that we have in the marketplace in general. Now, where are we headed, in terms of the economic environment in 2023? The OECD, which is the Organization for Economic Cooperation and Development, is projecting that in 2023 our growth will be just 0.5%. So we'll grow but barely grow. Okay. The core PCE, which today is 5.1, will go down to 3.6. So it won't be at the 2% that the Fed is targeting, but it's going to go down a little bit in 2023. And unemployment, which is currently at 3.7%, is going to pick up and go up to 4.2%, as I can see. So, and these statistics, they come out monthly, so this information next month may be different from what I'm telling you today. Likewise, consumer spending. We know that consumer spending is 2/3 of the economy. Now, prior to the pandemic, households were saving 8 to 9% of the disposable income every month. During the pandemic, they didn't have anywhere to go and spend money, so they were now saving 17%. After 2021, with those little bit of opening up in the economy, that went down to 12%, still 150% of what the original savings was. So a lot of household savings of money has been built up over time, and that is what is keeping the economy going. Now, if you think about it, we have today roughly $1.8 trillion that has been built up, and that can keep spending going for another 9 to 12 months. And you see that in the stock market, right? There's a direct correlation between money supply and stock prices. So consumers are spending money, and the stock hasn't done too badly in 2022. So the question is, what changed in 2022 that caused the Fed to take such aggressive action? And I can think of 3 trends that probably led the Fed to take such aggressive action. One is that we moved from a situation of insufficient demand to insufficient supply, right? So when the pandemic was, broke out, the whole system came to a halt. There was, a lot of stimulus money that was being handed out by the government, and that caused demand to surge ahead of supply. Now, supply can be affected by a variety of factors. It can be affected. It was affected by the pandemic, by the war in Ukraine, geopolitical tensions in China. There were sanctions. There was labor shortage. All kinds of things that were going on. And because of these supply shocks, what happened was that we started revisiting the entire thought process about globalization that started 25 years ago, and we started thinking of bringing manufacturing back home, what they call as nearshoring. And so there was no talk to say, I'm going to reestablish the supply chain that existed before the pandemic. So that is where, the insufficient demand to insufficient supply situation. If you want to understand the impact of the supply chain, I just have to give you one example. And this is something that Bill Broderick was talking about, semiconductor chips, yesterday. And I was telling him that, what do you think will be the impact on the U.S. economy if we lost access to all the semiconductors from Taiwan suddenly? And I was telling him the answer probably is it'll affect 10% of the GDP, and we'll have a severe recession, if not a depression, just for that. So you understand the importance of the supply chain itself, The second, trend that happened that led Fed to become very aggressive really is the ending of the liquidity that was being supplied by the central banks, right? There was a change in the economic landscape, change in the thinking of the Fed and how they want to approach things. And they started tackling the inflation problem with a sledgehammer, and they were basically, they increased the Fed funds rate by almost 16 times, 0.25% to 4%. The markets had gotten used to free money, from the central banks, and all that money was flowing into private equity, hedge funds, less regulated entities. And there's a separate subject about, alcohol being served well into the night, for all these private equity firms who really borrow too much money and, take all these companies to the edge of bankruptcy and then let it go public under unbelievable valuations and all that. That's a problem waiting to happen in the debt markets at some point in time. The third thing that happened is that the markets realized that the Feds may be trying to make up for lost time. Because inflation started in April 2021, but they didn't take any action until April 22. And so the market started thinking that the Fed is going to keep the rates higher for longer. So that was what caused volatility and fragility, in the markets to many extent. Now, interestingly enough, if you guys read the Wall Street Journal 2 days ago, there was a headline there. The headline was, this is on the front page, questionable assets ruined FTX rescue. Now, for those of you who are not familiar with FTX, it's in the crypto business, right, to put it simply. And this headline caught my attention for two reasons. Because so many companies, you're talking about a total amount of assets in the crypto business of $3 trillion that lost 72% of its value in a matter of days. And we did not see any impact on our financial system discernibly anywhere, right? And that got me thinking, why is that the case? Well, how is it that we are not being impacted by all this crypto? The answer was simple. The cryptos are not part of the real economy. They lend money, they borrow money, they trade money all amongst themselves. And the banking system does not lend them any money. So if you look at the prospectus for all these crypto companies, they don't find any loans from banks. So that is one reason why it caught my attention. The other reason it caught my attention was that a lot of the problems that we have in the markets today really have its origin in questionable assets that the Fed started buying in 2008. And at that time, we did not see any headlines anywhere saying questionable assets are ruining the Fed's rescue. Did we see that? No, I don't think so. So we had that situation. So what exactly happened in 2008? Under the theory of, greater good or salvaging the banking system, the Fed started buying worthless assets, toxic assets, securities that were worthless, and they, put them on the balance sheet. And how did they do that? They just printed money, So they printed money, and so the Fed was drinking some sort of a Kool-Aid, and they passed the Kool-Aid around to the Bank of England and Bank of Japan, and worldwide, the amount of money, the fake money that was introduced was to the order of 30 or 35 trillion dollars, when the world, GDP is 85 trillion, which is almost 40% of the world GDP. But forget about the world, just think about what's happening in the US. You've got a Fed that has a balance sheet of what's Fed's balance sheet today? Yeah, the Fed's balance sheet today is, it's roughly $9 trillion, okay, it's $8.7 trillion. And that partly it's that high because they bought all these toxic assets, since 2008. And because the money never went into circulation, we didn't see the impact on inflation, and we have been obfuscating the problem of true supply and true demand in the economy for almost 14 years. And because when fake money was being put into circulation, it is going into assets, it was getting a very high valuation. See, the asset prices were unbelievably high. But you have to take that fake money out of circulation in order to know what the true supply and true demand is, which is what the Fed started doing this year. They started taking out $40 billion, $45 billion beginning of the year. Then they realized they were going too slow. So by September, they said, no, we got to do more of it. They started doing $95 billion. But think of it this way, if you're taking $9 trillion balance sheet and trying to bring it down to $6 trillion in 3 years, $100 billion a month barely takes 3 years for you to take that money out of circulation. So it's going to be, and the reason why I'm mentioning all this is to give you an idea that we are dealing with a problem much bigger than what a few interest rate hikes can solve. In the immediate present, we feel, the Fed has been so aggressive, they've increased the interest rates, but the problem they're dealing with is much larger than what can be solved with a few interest rate increases in a very short period, which is all that has occurred so far. Now, unfortunately, when in 2008, they had this pseudo theory of what they call as a modern monetary theory. You keep printing money, and you smooth things out, and you have growth in the long run. That's what they were trying to do, right? Unfortunately for them, it didn't really work out that well. So, while it's important and healthy for the economy to remove all this fake money from circulation, it's going to take time. And the reason I'm really pointing all of this out is because Fed has gotten a pretty bad rap, right? The Feds, you always read the newspaper and they say, well, the Fed's being very slow in reacting, or they're looking in the rearview mirror, they're solving yesterday's problem. The Fed is at constant level of criticism. Some of it is justified, not necessarily but the way Fed relies on data. Now, what are the two main things the Fed is looking at? Inflation and unemployment, right? But if you think about it, how do they get the information on inflation? They've got a bunch of guys walking around with iPads, making phone calls to random businesses in random locations and trying to collect information on inflation. It's a very archaic, rickety system, outdated probably. But, to the extent that you're collecting information in that form, you're looking in the rearview mirror, but you're trying to drive ahead. Whereas if you want to be, looking at real-time information, what do? Again, as I mentioned, inflation is when goods and services are exchanged for money, right? So you go to where the payment trail is. Now, why wouldn't, in the 21st century, the Federal Reserve get information from Visa, from MasterCard, American Express, latest information, and start looking ahead? Because that will give you real-time information on what's really happening.